Hey everyone, welcome back to the channel. Today can be a little bit different of a video. So I came across this list the other day, and it was like the 10 top performing stocks of the 2010s. And I was looking through it, and I saw Domino's Pizza at number two. I thought that was just such a crazy company to be on this list with a 4,000% return on its stock. And I understood like Netflix, tech, it really took off from streaming and everything. And there's some bioscience and some other tech companies. I was like, okay, some of that makes sense. But Domino's really, I was a little confused. So I decided to go back and build out a model as if like we were in 2010 and trying to predict how Domino's Pizza would do. And let me pull up their stock and just I'll show you back then. Um, So back in 2010, if we just go like, we'll go January 1. That's when I pretended I did this model as $11 a share. I did the calculation. They had so many shares outstanding. It was like about a 480 um, or $420 million market cap. So first thing I did was I predicted out their DCF. So here's what I did. Right, I built out the financials. So I put in their actuals from 2006 to 2010, predicted out revenue by business line, and they had company-owned stores, franchise, um, supply chain, and international. And if we kind of looked historically, we saw like international was growing, supply chain was kind of hurt during the financial crisis, but it looked like it was stabilizing. Domestic franchise was decreasing, and then store-owned was decreasing as well. But if they had some metrics in there, and it was if we looked at like number of stores, we could see domestic stores that were company owned was decreasing. Franchise stores was increasing, and then it looked like they lost about 100 of them. International was really growing. So I predicted this out kind of, and I gave them a lot of credit, I think. Domestic company-owned stores, right? I was like, okay, this is going to slowly come back, and we're going to get up to like a 6% growth. That seems reasonable for a pizza chain, just growing mid-single digits, nothing too aggressive. Same story for the domestic franchise. I gave them up to mid-single digits. Domestic supply chain, I was like, okay, this is going to normalize out. And similar story, I was like, this will just be a kind of steady run business. And then international is like, okay, this is where the growth is going to come from in my mind. If we looked at kind of, that was the only place I was actually seeing growth, and we saw pretty big store openings. So there's a story there, right? They went up 1,000 stores in the 5-year time period there. I was like, that could be the big growth driver, right? So forecasted that all out, and you know, you go from like declining sales, little predicted decline, and then we're going to slowly rebound and get back to that mid-single digits. COGS, they had seen significant improvement. I felt like, okay, we'll just hold that constant. Maybe the margins are better in international or something, and the franchise-owned stores. SG&A, didn't really tweak it much, just kind of left it the same. Tax rate, that's just for part of the DCF. 2020, it would change to 21% when the tax reform stuff hit. CapEx, historically, it looked like they cut CapEx in the downturn. Um, so I kind of had it growing and building back up. Depreciation as a percent slowly going down to about 80%. That way you actually have growth CapEx there. And then working capital, I mean, they were pretty flat on like the working capital stuff. Nothing crazy, pretty minimal. So kind of just neutralized it out. Right. And I was like, okay, so what does that give us? Okay, that gives us a equity value of 539 million. So right there alone, and that's if we need a 10% return, right? So arguably you could say, hey, if I hold this for the next X amount of years, um, I guess you get like a 10 and a quarter, you know, 10.4% return, which is pretty good, right? S&P on average returns probably 10 to 11% pre-inflation. So I mean, this is just like a typical S&P 500 company, right? Like it's not going to be anything crazy. You're going to get similar returns to the S&P 500, but it seemed fairly priced, right? Um, Obviously, we know based off how the stock went up 4,000% in the last 10 years, they didn't just kind of come back and be a regular pizza company. So I took their financials and I pulled in their actual financials. and link that up to a DCF as if we were 2010, just to kind of get a stock price and see like, is this thing massively undervalued based off how they actually performed. And what was interesting is you're looking through this. So domestic company owned, it kind of, and here actually, do I have the growth percents calculated? Yeah, it kind of, is that linked up? That might not actually be linked up. Let me link this up and we can look at how it actually grew, right? And see like how far off were we, you know? And it's kind of all over the place, right? But like 2.9 minus 2.7, they closed a ton of stores. Something happened there. Maybe I don't, yeah, something funky happened in 2013, came back. So maybe they renovated a ton of stores, closed a bunch. Um, right, but like it's kind of all over the place. Um, and I mean, I should have just calculated the CAGR. That would have been the appropriate thing to do here, which is like this divided by this raised to the 1 over 10. Is that CAGR? Minus 1? Yeah, so okay, there we go. Maybe that's a better way to do this. We can kind of see here, right? Like 3.1, okay, we were, predicting not too much different, right? We're probably somewhere in that same range. And here, let me just I can copy these CAGRs over. So 2.8, right? We were 3.1. We're pretty close. But here for franchise, right? Obviously the franchise grew pretty well. It immediately bounced back and just kind of accelerated. And that kind of goes back down here. If we look at, I don't know if I brought in all the metrics, to be honest, actually. Domestic stores, you can see by the end here, we're at 5,800 stores versus 4,600. So they continued to grow that for the domestic franchise. And so combined domestic stores, 6% is what actually happened. We were 3.6. But then supply chain, this is what's crazy. 1.8 is what we kind of predicted, right? We're like, okay, you're going to kind of stumble your way back. What really happened here is, look at this, right? We're going from 760 to 2.1 billion, tripled, average 10% growth every year, 11% growth every year. That's huge. And I was like, I don't even know what this domestic supply chain is. Like, high level, I'm thinking this is just them manufacturing goods to sell to their franchise owners. And that's exactly what it is. I Googled it, read through their 10K. Looks like they have, I think it was like 500 locations where they manufacture pizza dough and marinara sauce. And then it just gets distributed to all their franchise holders, and it's clearly a very fast growing and very lucrative business. So it's basically the domestic franchise, that's like the royalty. I was thinking that was just like the gross profit when I was first looking through this, but really that's just kind of like the royalty line, I believe, and then in like percentage sales. And then this is where the real money is of all the volume those stores are doing. Obviously, they're paying Domino's for the ingredients. And then international, actually, it dipped, but it did end up growing at about 5.1%. So, I mean, we were thinking 10%. So, not quite as strong growth as we hoped. But, anyways, when you take their actual numbers, pretty fascinating stuff. We get an equity value of 2.6 billion, right? And they were valued at 400 million. So, I mean, right there alone, it makes perfect sense that that a fair value back then would have been 2.6, so they were already undervalued by 2.1 billion, or you know what I mean. They had based off how they actually performed. Obviously, you could never predict how they were going to perform. That's pretty crazy to see that the supply chain grew so much, and it could be they just raised prices to their franchise owners, or maybe their franchises are doing much better and selling much more volume, and the royalty fees or the licensing fee stays the same, but the flow through there just increased dramatically. So yeah, I mean, right there alone, right? It's what, six times undervalued, so 600% growth right there. So yeah, I thought that this was just kind of like a fun look back to kind of try to understand what happened with Domino's, and if there was a way back then, could you have predicted this? I think that's the hard thing, right? Is I felt like my model was actually pretty, you're coming out of a financial crisis, things are rebounding. You're like, okay, you got Domino's, Pizza Hut, Papa John's are kind of the big players. but it's, delivery pizza. Like this business isn't, gonna just all of a sudden take off like wildfire or anything, I don't think, right? Like we've always had delivery pizza. It's a thing since probably early 90s, if not before then. Um, but I guess that's when like Pizza Hut was huge, was like 90s, early 2000s, things like that. And um, to predict that this supply chain, so basically their franchise businesses were just gonna accelerate like crazy. That's a hard thing to predict. And I guess if you were really, really bullish on their franchise stores, right? Back then they had 4,400. I mean, it only increased 1,000 stores. So the stores increased what, 25%, but their domestic supply chain increased 300%. So something was going on there, and if you could have seen that coming, and I guess if you look at the international stores too, right? The international store count grew tremendously, from 4,000 to 11,000. So a lot of that could be coming from there as well. So definitely an interesting look, and if you were really bullish on it back then, you would have seen, even if you could have predicted this, right? You'd been like, okay, massively undervalued. Easily, this is going to be a 5 or 6 bagger in the next 10 years, right? Um, and I mean, look, right, we can adjust this. Like, let's see, what percent would this give us to, so like 15.5%? No, 15 3/4, something like that. Yeah, 15, basically call it 16%, right? You've been like, dang, this is 16% return on Domino's over the next 10 years if you could have accurately predicted this, and understood kind of that business model, the supply chain aspect, and the franchise store growth story at the time. This would have been a no-brainer. So definitely, it was interesting to look back at it. Just kind of just like a fun little analysis. I was just kind of curious looking at it, so thought I'd throw this together. I hope you found it interesting, or I mean, I know obviously I'm not trying to look at the future of Domino's, but just trying to understand what happened and if there would have been a way to spot it beforehand. But definitely interesting to see nonetheless. So there you have it. The second fastest growing stock in the last decade was Domino's Pizza. So interesting stuff. Yeah, thanks for tuning in. Feel free to leave any comments or questions below.